Welcome to the Mainsail Financial Group podcast series, where we host industry experts to share some local insights, some guidance into areas that we don't really focus on day to day. We are still in the midst of the COVID-19 pandemic. So as you can see, I'm from home and Scott's from his pretty empty office, I believe, right now.
Very empty.
We want to thank Scott Kim for joining us today. There's been so much change in the world of taxes and, with asset prices all over and with, all these the new legislation, I thought it would be really helpful. Scott's actually the CEO and managing partner of Kvarak and Kim. Kvarak and Kim is a boutique CPA firm that specializes in tax compliances and strategy for wealthy families just right here in Bellevue. And so, again, I think with everything going on, couldn't be happier to have Scott here. I really appreciate your time here today.
My pleasure. Thank you for having me.
Yeah, of course. So I guess we'll kind of jump in. And again, with just everything going on, I feel like there's been so much change, even just this year alone, that it's really great to have you on here. I don't want to spend a whole lot of time necessarily on the Secure Act. I think there's some other areas that maybe we can dig in a bit more.
Sure.
But that did go into effect earlier this year. And, some of those provisions affected how accounts are distributed to beneficiaries. So I was hoping you could maybe shed a little light on that and some strategies that, folks can use to maybe minimize the taxes to the next generation, if possible.
Yeah, so we can go into the estate planning arena a little deeper into the conversation. But in this the first quarter of 2020 has been a weird for medical industry, for finance industry, and tax law as well. It's the Secure Act, which was passed in late 2019, was really the IRS and our fiscal budget trying to put those things together and making all the funds work for the long term, and the Treasury realizing that, look, we're going to have to pull some money into an earlier time frame to make the funds work and make the budgets even out. And then what happens was the coronavirus, and that kind of shot all that theology and idea out the window. And the Treasury, at the advice of the Congress and the executive branch, went into a mode to where they wanted to push money into the economy versus having them pull out in a shorter time frame. So the Secure Act was unique in that it changes the time frame of when you inherit an IRA and how you can get the money or how much you can delay the funds coming out to you, therefore being taxable income. So when you inherited an IRA before, you were able to determine the distribution based on the lifespan of the beneficiary. But with the new Secure Act, what it did was now you have to take it out in 10 years. So if you're in your mid-20s or mid-30s, and you get inherited an IRA, now you're required to pull that into taxable income in a shorter time frame. There are exceptions to that rule, but generally it's going to be a 10-year span now, where if you inherit, let's say, $100,000, $200,000 of value in an IRA, you're going to have to pull that all out in a 10-year time frame. That changes your income. It changes your income tax bracket. It can have an effect on what the net tax will be, the income tax will be for the beneficiary. So there's some planning to do there. There are exceptions to the rule. If it goes to a spouse, the spouse can still take the distributions out at his or her lifespan. And if it goes to a minor child, then that minor child is not subject to this 10-year rule until they they get to age 17 or older. Or if you're ill and you're disabled, then you're not subject to that 10 years.
Sure. Okay.
But other than that, the 10-year window changes the game for inherited IRAs significantly, and is cautious of. Yeah.
Okay. And to, I guess maybe continue down that path a little bit. I know a lot of the folks probably that you work with, a lot of folks here in the area, that do have, significant net worth, a lot of times, a lot of that is tied up maybe in one particular company's stock.
Yes.
Given what's going on right now, are there some certain strategies that you may be looking at to help, while asset prices are low, or some things that you can do to maybe get some of that out of your estate in the current environment?
Yeah. So if you are, I try to convince a lot of my clients not to be emotionally tied to a single stock, but that's nearly impossible discussion, because as you would imagine, if you work for a company long enough, you're going to be pretty invested and emotionally tied to the culture and the product of that company. There currently, the estate tax it gives you an exemption of almost 11.6 million. And so you have an individual can gift up to that amount to the next generation without having to pay gift tax. Now, what that does is it uses up the exemption that's possibly left over, or what you would have left over when that individual passes away. But it's not when the value is low. It's not a bad time to shift some of that gain or shift some of that value out of your estate when you would use up less of the exemption because of the decline in value. And if you believe that the company or the markets will come back, like it historically always has, then you're pushing the appreciation out to the next generation and not subjecting that to your estate tax, which could be 40%, up to that, as well as the Washington State estate tax at 19% maximum. So that's one strategy that a lot of our clients have used, is gifting assets when the value is low. Also use various trusts to gift assets to the beneficiaries, so that you're not giving a minor child a ton of money right away.
Sure.
Or somebody even in their 20s and 30s where they haven't maybe established what they want to do with their lives. Also, this is a time where with the values being low, you can get a discount in various assets that you gift. For example, a lot of our clients put securities into an LLC, or investment assets to an LLC, and then gift that to a trust or other beneficiaries. And by doing so, they can take advantage of lack of marketability discount and minority interest ownership discount on that LLC unit. All in all, it brings the value of the gift down while keeping intact the actual market value of the securities within the LLC.
Sure.
There's a lot of tactics at hand that people can utilize.
Okay. And you mentioned just a minute ago, you mentioned the estate tax as well. Do you mind just sharing a little bit more? You mentioned the federal exemption. Can you give us an update on the?
Yeah, good point. So the Washington State estate tax is it's set at $2 million with rated increase for inflation. So if married couples, let's say $4 million, if married couple something tragic happens and they pass away with $5 million in net assets, the first $4 million roughly would be excluded from Washington State estate tax, but the $1 million that's left over from above the $4 million would be taxable for Washington State estate tax, and could be taxable all the way up to the maximum 19%. So, with the federal exemption, with the married couple combined, with those two being about $13 million, and Washington State being at $4 million, you could be a couple could be in a position where there would be no federal estate tax, but a pretty big sizable Washington State estate tax. And Washington State, luckily, does not have a gift tax, so you can gift away as much as you want during your lifetime and push that out of the Washington State hands, so to speak, for their estate tax.
So that's really helpful for those folks right in between then, right?
That's correct. That's correct. So there's some planning to do. How that individual or family would need to hire an estate attorney to write up the plan and draft trust documents if necessary. But even though a family would be a net worth of under The federal exemption doesn't mean that there's no planning to do. There's
Sure.
some planning that they should consider if they're exposed to the Washington state estate tax.
Yeah. Okay. And I think one of the key aspects of that is that, I think a lot of people think of their investment portfolio, but the key is that estate is everything, right? So
Yeah.
the
Yeah.
reason I bring that up is here in Washington, especially, I mean, with the way properties have, appreciated, we find that, people may have a primary and a rental, and all of a sudden that with their investable assets pushes them over that pretty quickly.
That's right. So you take a couple in their, in their 50s, and they've been working and putting away money into their retirement throughout their careers, and they have middle income homes, and a nice home in our areas are going to be well over $1 million these days in value. So you take the retirement accounts, and you take the home, and a family. It wouldn't surprise me to push up against that 4 million without really even feeling wealthy, to be honest with them. And so it is something that they should talk to their estate attorney and their accountants about.
Okay. Yeah. And is there anything with the real estate side of things specifically, any specific strategies you can think of there that you guys look at often?
Yeah, so when it comes to real estate, there's if it's a rental or a primary residence, there are different planning techniques. But what's going to hit most of the public is their primary residence, and if they wanted to push that out of their estate into the beneficiary hands, but still be able to live in it, there is a trust structure called qualified personal residence trust. So what that does is you take that piece of property, put it into a trust, and over the duration of the trust, it's still held in your name. It's a grantor trust, and it's held in your estate, but if you live the term of the trust, it bypasses to your beneficiaries. So because there is a term to the trust, you actually discount the gift. So let's say if the home is worth $1 million, you put it into this trust. The value of the gift, because it's of a future value, future time, and based on present value, it's going to be less than $1 million that you actually use up of your gift exemption. And if you do outlive the trust, what happens is that piece of real estate goes into the hands of your beneficiaries via another trust or directly to them, and you just rent the home. You rent the home from your beneficiary. So there are other things, cash flow considerations that you have to take into account. But it can be very valuable if you own a multi-million-dollar home and you want to move it out of your estate now versus having it exposed to the Washington state estate tax at time of death.
Yeah. Okay. That's great.
Yeah.
How about folks with potential real estate in other states? Now, if you're here in Washington, you're subject to our estate tax, correct?
That's correct.
So what can they maybe do? Is there any nuances to that?
There are. Now, that's more in the arena of an estate attorney, but what I have been told, what I've seen clients use or try to avoid mostly is to be exposed to the probate process in those jurisdictions that have an estate tax. To avoid that process, the recommendation that most of our clients get is to hold that piece of property inside of a revocable trust. So a revocable trust meaning that you haven't given the asset away, it's still part of your estate, and it doesn't create any income tax complexities, but for estate tax purposes, it avoids your other assets or your other assets being pulled into that state's probate process. Okay.
Great. Yeah, that's super helpful. I'm sure a lot of people will get some value out of that portion.
Yeah.
I want to switch gears here maybe a little bit. We've talked a lot about the asset side of things, but can you maybe speak a little bit to, I guess, especially with what's going on right now, a lot of people are giving, help first responders or whatever it might be. Can you talk a little bit about making the most of charitable contributions or charitable gifts at this time?
Sure. Most of our clients are very charitably inclined. Most of our clients have accumulated excess net worth. So giving away money to their causes that they believe in is a very important thing that's part of their estate plan. So with the couple things that changed with the new CARES Act, because the CARES Act, which came out as a response to the COVID-19 pandemic, was that one, an individual who's not itemizing gets a $300 deduction above the line for charitable donations. So that wouldn't matter to most of our clients that do itemize, but with itemized, with the standard deduction going up to 24,000 and beyond for married couple, we do have some clients that are not itemizing now that you before. So that $300 above the line deduction could be a minor benefit, or maybe you have a working young child that's not itemizing because they don't own a home yet, and that might benefit from the $300 above the line deduction. The second thing that is kind of convoluted and kind of complex is within the CARES Act, the IRS drew in the law that an individual or a taxpayer can deduct up to 60% of their adjusted gross income with cash donations. It sounds fantastic. If you had intentions to want to give more than 50%, which was the previous rule, but that the whole 60% has to be all cash. Most of our clients do give away non-cash goods in the form of whether it's just minor goods to Goodwill or whoever organization that may be, and or appreciated securities to their donor advised fund or outside charities. Because of the ordering rules when it comes to charitable donations, if an individual has non-cash donations like appreciated securities, then the 60% doesn't really apply. It does come back down to 50% for cash. And we could get deeper into the reason why that's the case, but I feel like this 60% was thrown into the law without really taking into effect who it's going to really help. My guess is that this 60% is not going to be taken advantage of by most people, because it just won't be. People will give away non-cash goods where it will drive that 50% down to, or 60% back down to 50.
Sure. Okay. And I apologize, Scott. You might see me. I might be frozen on there. For some reason, we're having a little technical difficulties.
Oh, no problem.
But we can keep going. I'm still hearing you okay, as long as you're hearing me. So.
Yep, I'm hearing you.
Okay. One of the things I wanted to maybe touch on as well is that, I think one of the things that we run into a lot is that typically the more complex an investment vehicle may be, it may also lead to more complex tax implications, I guess, as well.
That's right.
And I was hoping you might be able to speak to that a little bit to kind of give some insights around that.
That's right. So as you would imagine, most of our clients that are have created excess wealth, they tend to start investing like an endowment fund, for example, where the alternative investments start to make sense. Those alternatives, for an example, could be private equity funds, real estate funds, and or hedge funds. And without going into the gritty details of certain of attributes of some of those funds, before a taxpayer or one of your clients goes into one of those vehicles, they need to be aware of some of the exposure to other outside reporting or other tax that those investment vehicles will give, and those include exposure to other state tax, income tax, if that real estate fund is holding real estate in other states that have an income tax regime, or a hedge fund that's operating like a business versus an investor. That business income will be taxable in that jurisdiction as well. And many hedge funds and many private equity funds recently in the last 10 years have gone offshore to continue to look for the excess return. And that also creates foreign income tax reporting, which can be cumbersome, as well as some additional foreign income tax to be paid based on when those funds come onshore, when the income is recognized for U.S. tax purposes.
Mm-hmm. Okay. Yeah, that's super helpful. I think that's something that's missed quite a bit. So I appreciate you digging in a little bit there.
Sure, sure.
And I think maybe that's a good place to start wrapping up, but I want to kind of give you the opportunity if there's anything else that maybe, you know, we missed from an estate planning standpoint or anything like that, that may be helpful to touch on.
I think, you know, the only thing that I could think of is that we didn't really touch too much on the CARES Act, just to summarize some of the important aspects that you may get questions about is the refund of the 2020 CARES Act. You know, how much the client will get, when they will get it. You know, for a single taxpayer, it's up to $1,200. For a married filing joint, it's $2,400. They can get additional $500 for a qualifying child, but the law does create a phase-out rule where, for example, if a married filing joint starts to make over $150,000, or it does make over $150,000 based on either 2019 tax return filed or 2018 if they haven't filed 2019 yet, there is a phase-out where they will get less than the maximum $2,400. That's something to think about or to be aware of, because I'm guessing your clients will have questions for you related to that. And then if you have clients that unfortunately did contract the virus, then they could potentially take money out of their IRA and not have to pay the 10% penalty. But hopefully you don't run into that situation. But I think the big one is that the required minimum distributions for retired 72 years or older clientele is waived, so they don't need to take that if they don't need it. What that does is it reduces their taxable income for 2020, and they defer the recognition of that income into a future year. So
perfect. Yeah, thanks for bringing up the required minimum distribution part of it. I think that's really important for folks to know.
Yeah, yeah. A lot of interesting things going on.
Yeah, no kidding. It's been an interesting year for sure.
Yeah.
Well, hey, I appreciate your time. If folks do have some questions for you or want to get in contact with your firm, is there a good way for them to get in touch with you?
Yeah, just go on to their website. There is a place in the website where they can put in their information, and it will send an email to us. The website is Kovarik and Kim, all spelled out, .com.
All right, great. Well, thanks again for your time. I think there was some really good stuff in there, so I appreciate you.
My pleasure. Hopefully it benefits.
Yeah, absolutely.
All right.
And thank you guys all for joining us for the Mainsail Financial Group podcast series. If you do have any questions for us, you can email us directly at info@mainsailfg.com. That's info@mainsailfg.com. Again, thanks for your time, Scott, and look forward to catching up again here soon.
Thank you for having me.